the stock market, is it already too expensive to buy in? So let's take a look again at the facts and ignore the media bullshit narrative, right? Now, some people would say that the stock market is expensive. Why? Because they look at certain metrics. They look at this thing called the price to earnings ratio. And if you look at the forward PE ratio of the S&P 500, it is now at 22.4 times. So is that high or low? Well, if you compare to the last 5 years, the average PE ratio, forward PE was 20 times, and the average in the last 10 years is 18.7 times. So purely from a PE ratio perspective, yes, the market is above the historical average, okay? But is it very high? I wouldn't say that. It is slightly above the average. Now, however, I've said many, many times, PE ratio by itself can be very meaningless, can be very, very, what's the word for it? Misleading. Why? Why is PE ratio very misleading? Because it doesn't take into account what? What doesn't it take into account? It doesn't take into account the growth of the earnings, right? So remember, PE ratio, it doesn't take into account the growth of the earnings. And are companies growing earnings faster today than 10, 20, 30 years ago? Yes. And like I said, companies' profit margins are triple today what they were 20 years ago. So you cannot compare today's PE ratio with the PE ratio 10, 20, 30 years ago. It doesn't make any sense. Okay? Now, remember this. If I have two companies, company A and company B, company A PE ratio is 5. Company B PE ratio is 30. Now, which is the more expensive company? Which stock is more expensive, A or B? Now, a lot of amateurs will say B, right? Wrong. Who says it's B? It depends on the earnings growth. What if I told you that company A, the earnings are growing at only 1% a year? But company B, the earnings are growing at 30% a year. Now, which company is cheaper? Now company B is cheaper, right? Why? Because if you take the PE ratio, divide by the earnings growth, you get the PEG ratio, which is a more accurate way of measuring it, okay? So 5 divided by 1 is 5. This one, 30 divided by 30 is 1. So company B, PEG ratio 1, cheaper than company A. That's why 3 years ago when I bought NVIDIA, NVIDIA's PE ratio was 60. People say, Adam, it's so expensive. Are you crazy? I say, no, it is not expensive because NVIDIA is growing their profits at 30, 40, 50%. And since I bought NVIDIA, it's up over 1,000% in the share price. Why? Because NVIDIA is not expensive if you take into account the growth of their earnings. Later, I'm going to show you. By the way, have you guys heard of Palantir? Now, is Palantir expensive? It used to be very expensive, right? But recently, based on their last earnings report, if you take the latest valuation, Palantir is no longer very expensive because the earnings have grown into the share price. Same thing with NVIDIA. NVIDIA's earnings have grown into the share price. So you cannot just look at the share price and say, oh, the share price went up 1,000%, is expensive. Rubbish. If the share price goes up 1,000%, but the profit goes up 1,000%, then the stock is not more expensive. Okay? So we're going to look at all that in a short while. So hang on with me. Now, what's more important is to look at not P ratio, but what? But what? The PEG ratio of the S&P 500. And if you look at the PEG ratio today, when I talk very passionately, I get very hot. Then I start sweating. So I need to full blast my aircon now. Hold on, give me a sec. Okay. The PEG ratio of the S&P 500 now is only about 1.3. Is that expensive? No. Use your brain. Okay. I'm talking to people who say, oh, the market is expensive. No, it's not. Look at the PEG ratio. It was at 2. It was at 2.4. It was at 1.7, 1.5, 1.5, 1.5, 1.5. Right now, we are here. If you take into account the earnings growth of the companies today, we are not as expensive as where we were in the past 20 years. Right? Okay. Let me show you this chart. Now, people who say that now the market is like the dot-com bubble in the year 1999, 1998, 2000, they are freaking idiots. They are freaking, I'm just being very polite today, okay? They're freaking idiots. Now, I'm old enough to remember the dot-com bubble because I invested during the dot-com bubble. And I can tell you that today's market is completely different because during the dot-com bubble, the stock price went up every day, okay? Every day. Companies don't make money, companies have no revenue, the stock price also go up. Now, that was a bubble. Today, you got companies like Nvidia, like Amazon, like Palantir, they show very good profits. The stock price drop. That's not a bubble. That's not a bubble, right? It's totally different. Now look at this chart. This was the dot-com bubble. Now, this line in brown is the share price. Okay, this is the share price. And this line in gray, that is the earnings of the company. Now, you can see in the dot-com, the share price went up, but the profits were very low. And that caused what we call a bubble. And that's why it collapsed. Because eventually the share price will come back to the value of the company based on what it can earn. Understand? That's why I always say, as investors, you always have to calculate the intrinsic value based on the earnings and the cash flow of the company. If you look at today, the companies that are leading the AI revolution, yes, the share price has gone up a lot, as you can see, but the earnings have been supporting the share price. Nvidia is reporting record earnings, Meta record earnings, Amazon record earnings, Apple record earnings. The earnings are there. This is not a bubble. If you think it's a bubble, you are very stupid. I don't mean to be rude, but you're really very stupid. Okay? Now, having said that, are there areas of the market that are in a bubble? Are there certain areas that are irrationally priced? Yes. Okay. And I showed this slide about 1 month ago. If you guys have been following me on YouTube, I showed this 1 month ago. I said, be careful of these stocks. Remember, I said these stocks are bubble. Why? Because many of these stocks, they don't have any profits. They don't have any profits. The share price going up is purely on hype, not on profits. Okay? So what? So are there some AI stocks that are bubble? Yes. Like CoreWeave, that's a freaking bubble. Okay? Like Nebius, that's a freaking bubble. Now, the good news is that this bubble has already started to burst since I talked about it 1 month ago. So since I talked about it, CoreWeave is down 60%. Nebius is already down 30%. Okay? Quantum computing stocks. This is also a bubble. This is also a hype, all right? This IonQ is down 40%. RGTI down 55%. Now, some people say, Adam, does it mean that now is a good buy? Is this now a good buy? Hello? Hello? What do you think? Down 40%, down 50%. Is it now a good buy? Well, in my opinion, I wouldn't dare to buy. Why? because these companies don't make money. So even if it drops 90%, I still won't buy. I still won't buy because there's no commercially viable quantum computer yet. And they said one day we'll make this computer. This one day maybe 30 years from now. Okay? Next, cryptocurrency treasury stocks like MicroStrategy, or they call it strategy, down 65%. Or BMNR that buys Ethereum, down 80%. Now, you guys know how I feel about cryptocurrency. To me, cryptocurrency is something you can speculate. You can trade it. You can make a lot of money in crypto using short-term price manipulation trading. That is what Alson will teach you later on, all right? But for investing, no. Because there's no profit, there's no cash flow. It is driven by the greater fools theory. So this can drop 90%. I still would not dare to buy it, okay? Nuclear energy stocks. Now, nuclear stocks, I think, have a lot of potential. They have a lot of potential. In fact, I like to invest in nuclear stocks, but I think they are still a bit expensive, right? So like Oklo down 45%, SML down 65%, okay? Uranium stocks. Now, LEU, Centrus Energy down 48%, Chemical down 25%. If you ask me, out of all these companies, I would say the only one that I think is still not bad is actually Comico. This one is still not bad. This one is still not bad. All right. Now, why? Why do I say not bad? Okay. Again, let me show you very quickly. If you look at Comico, let's look at some of the fundamentals, shall we? Okay, so let's look at Comico, right? CCJ. And like I said, this is not bad. Now, it doesn't mean that I'll invest in it. I still wouldn't dare to invest because to me, it's not safe enough, right? But at least if you look at Comico, you can see that, oh, it's still a bit expensive, sorry, right? The intrinsic value is $49. Now it's at 79. So it's still very expensive, right? Still very expensive. But at least it's making money. At least it's making money, okay? If you look at the financials here, okay, you can see that at least it is making money, right? It is profitable. And at least they have got positive cash flow, right? So this company at least is making money, but it's still very expensive. But if you look at the other company, which is the quantum computing, like IONQ, this one. First of all, there's no moat. And you can see that it doesn't make money, right? Look at that. Lose money, lose money, lose money, lose money, lose money, lose money, lose money. And the free cash flow is also negative. Okay. Now, always remember this, guys. When you buy a stock, what are you buying? When you buy a stock, what are you buying? You are buying a piece of a business, right? Okay. Now, what is a business? What is a business? A business is a money-making machine. The more money it makes, the more it is worth. Correct? The less money it makes, the less it is worth. Okay? If the business doesn't make any money, then what is it worth? If a business doesn't make any money, what is it worth? It is worth purely what people think it is worth, right? It's purely psychological, correct? And the trouble is that if something is priced based on psychology, based on perception, the trouble is once the perception changes, once people's sentiment changes, the share price can drop 90% or zero very fast. But if you buy companies that are actually making money, then you have no fear. Because even if the share price drops temporarily because of sentiment, you know that the company actually makes money, right? The price would eventually bounce back to the value of the cash flow. Okay, so that is something very, very important.